Welcome to today's video, where we delve into the intricate world of yield rates, exploring the crucial factors that impact productivity and success in various fields. And in this video, we'll unravel the concepts, explore how they impact various investments, and equip you with the knowledge to make informed decisions. Our first objective is to analyze a discounted cash flow. Second is to find yield rates. And lastly, apply the concepts of interest in real-life business situation.
I am Manilina Buemi, and I'm going to explain to all of you what is interest measurement of fund and one of its method, which is the dollar-weighted rate of return.
Hi, this is Charlo D. Aying, and I'll be reporting about portfolio and investment year method.
Hi everyone, my name is Vivi Balco. Let's talk about what is reinvestment rate.
I am Nina Marie Dinoya from Group 5. I'm gonna discuss about the proper way to calculate the portfolio rate of return, which is the time-weighted rate of return.
And this is Billy Joy Tugao, and I will be discussing about the discounted cash flow analysis, definition of yield rates, and the uniqueness of yield rates. Discounted cash flow or DCF analysis is a method of valuing a project, company, or asset using the concepts of the time value of money. It estimates the present value of future cash flows by applying a discount rate that reflects the risks and opportunity cost of investing in the project, company, or asset. So DCF analysis values a project, company, or asset by calculating the present worth of future cash flows considering the time value of money, and it applies a discount rate to reflect the risks and opportunity cost associated with the investment and providing a present day estimate of the asset's value. And the basic formula for DCF analysis is DCF equals CF sub 1 over 1 plus R to the power of 1 plus CF sub 2 over 1 plus R to the power of 2 plus CF sub n over 1 plus R to the power of n, where DCF is the discounted cash flow, CF sub I is the cash flow period I, R is the interest rate, and N is the time in years before the future cash flow occurs. So for example, our problem number 1. Suppose you are evaluating an investment that is expected to generate the following annual cash flows for the next 3 years. So $1,000 in year 1, $1,500 in year 2, and $2,000 in year 3. So if the discount rate is 5%, calculate the present value of these cash flows using the DCF analysis. And the given R for CF sub 1 is the $1,000 since it is in year 1. And for our CF sub 2 is $1,500 since it is in year 2. And for year 3 or CF sub 3 is $2,000. And for our discount rate is 5% or 0.05%. So using the DCF formula, DCF is equals to 1,000 over 1 plus 0.05 to the power of 1 plus 1,500 over 1 plus 0.05 to the power of 2 plus 2,000 over 1 plus 0.05 to the power of 3. And then calculate, and you can come up to 1,000 over 1.05 plus 1,500 over 1025 plus 2000 over 1 plus 1576. And to get the answer, you will divide it and you can come up with 952.38 plus 1360.54 plus 1730.92. Therefore, the present value of the future cash flows is approximately $4,043.84, and this represents the estimated current value of the investment considering the time value of money. So let's have another example. You're considering an investment that will generate cash flows of $1,000 at the end of each year for the next 5 years. And if the discount rate is 5%, what is the present value of these cash flows? So using the DCF formula, DCF is equals to 1000 over 1 plus 0.05 to the power of 1 plus 1000 over 1 plus 0.05 to the power of 2 plus 1000 over 1 plus 0.05 to the power of 3 plus 1000 over 1 plus 0.05 to the power of 4 plus 1000 over 1 plus 0.05 to the power of 5. So the solution is done that way because in the problem it states that the cash flow will generate $1,000 at the end of the year for 5 years. So mao na siyang nahimo na og 5 dinha. So for calculating the yields, input in your calculator the given values and you will get for DCF 952.38 plus 907.03 plus 863.84 plus 822.70 plus 783.52, and the DCF is equals to 4,328.47. So the present value of the future cash flow is approximately $4,329.47. So before I end my discussion on DCF, I would just like to add that this method aligns with the first objective of analyzing a discounted cash flow, since as it shows how to calculate the present value of a stream of future cash flows using a discount rate. Yield rates are rates of return on an investment that take into account the time value of money and the reinvestment intermediate cash flows. And they are also known as internal rates of return, or IRR, or the effective interest rates. Yield rates typically refer to the percentage of output or return produced by an investment, such as dividends from stocks or interest from bonds, relative to the initial cost or current market value of the investment, and it's a measure of the income generated by an investment. Yield rates refer to the return on an investment and are expressed as a percentage, and there are various types of yield rates depending on the context. First is the coupon yield. So for bonds, it's the annual interest payment as a percentage of the bond's face value. So for example, a $1,000 bond with a 5% coupon yield pays $50 annually. So that's 5% of $1,000. And next is the current yield, the annual income generated by an investment relative to its current market price. So for example, a $40 stock with a $2 annual dividend has a current yield of 5%, and that's $2 divided by $40. And lastly, yield to maturity, or YTM, the total return anticipated on a bond if it's held until it matures, considering its current market price, par value, coupon interest rate, and the number of years to maturity. So for example, for YTM, a bond with a face value of $1,000 a 4% coupon rate, 5 years to maturity, and a current market price of $950 may have a YTM that considers these factors for the total anticipated return. So to end the discussion of the definition of the yield rates, I would just like to add that this method aligns with the second objective of defining yield rates, since as it shows how to calculate the yield rate of an investment using the present value of the cash flows and the initial investment. Now let's proceed to the uniqueness of the yield rate. So the yield rate of an investment is unique if the cash flow pattern is conventional, meaning that it has only one sign change from negative to positive or vice versa. So for example, a typical loan has a conventional cash flow pattern as it starts with a negative cash flow or the loan amount and ends with positive cash flows, which is the repayments. However, if the cash flow pattern is non-conventional, meaning that it has more than one sign language, then the yield rate may not be unique. So for example, a lottery ticket has a non-conventional cash flow pattern as it starts with a negative cash flow or the ticket price and may have zero or positive cash flows or the winnings. So the uniqueness of the yield rate lies in its ability to provide a standardized measure for comparing the returns of different financial instruments, and each type of yield rate serves a specific purpose. So for example, YTM accounts for the bond's price, making it useful for comparing bonds with different maturities and coupon rates. And the yield rate reflects the income and return aspects of an investment, aiding investors in making informed decisions based on comparable metrics. So to sum up the uniqueness of the yield rates, I would just like to add that these methods align with the third objective of applying the concepts of interest in real business situations, as it shows how to determine the uniqueness of the yield rate depending on the cash flow pattern of the investment.
Hi everyone, my name is Vivi Balco. Let's talk about what is reinvestment rate.
Investment rate is defined as a portion of investor profit or cash flow that they reinvest back into a company or deal to continue earning a return that new capital. In fact, reinvesting capital over the long term is a key factor in any winning investment strategy across different asset classes. So, let's discuss a few examples to make it clear how investment rate can be applied to different asset classes to improve investment return. And commercial rate is real estate, where a specialized investor cash flow typically comes in the form of distributions from the proceeds or rental income generated from the investment properties. These properties can be owned directly by the investor, or if the investor is accredited, they can invest in the commercial real estate private equity firm like ours. Reinvesting is also a common strategy in the stock market, mutual fund, exchange-traded funds, and fixed income investing. Fixed income investment are another way to the real estate investor can receive cash flow to reinvest. The exact timing and structure of the interest payment depends on the type of fixed income securities an investor owns, whether the corporate bonds, municipal bonds, etc. When thinking about the private equity firm or corporation, there are three terms that investors need to know that calculate their investment rate. We're going to detail these terms. First, net working capital expenditures, change in net working capital, and net operating profit after tax. The equation used to calculate the reinvestment rate is reinvestment rate equals net capital expenditures plus change in net working capital over net operating profit after minus tax. Let's define this term first before I go to the example. What is net capital expenditures. Net capital expenditures is defined as the amount allocated to the capital expenditure less the asset depreciation that the capital expenditure is meant to address. Capital expenditure are the costs associated with replacing or improving an asset. Next is changing in net working capital. Net working capital refers to the difference between the amount of current asset and current liabilities that a company or investment firm has on hand. Change in net working capital refers to the location in the difference between current asset and liabilities over time. It is calculated by subtracting the net working capital for the prior period from the net working capital for the current period. So, change net working capital equals prior period new net working capital minus current period net working capital. Next is what is NOPAT. NOPAT stands for Net Operating Profit After Taxes. It is a metric that is meant to help investors understand how company or investment operation has performed after paying taxes on operating profit.
Calculate NOPAT equals operating income times 1 minus tax rate. Let's explore these terms one by one to make it clear. Operating income is a gross profit less operating expenses. For commercial real estate investors, this usually means rental income less expenses associated with maintenance, property management, insurance, and property taxes, not income taxes. The tax rate is the percentage of operating income that the government mandates that the company or investment firms must pay. By calculating minus tax rate, we are able to determine how much the operating income the company or investment firm gets to retain.
Next is example of the investment rate calculation. Now that we understand the formula and terms involved in calculating the reinvestment rate, matugay na katong net capital expenditures, change in net working capital, net operating profit after tax. Let's work through the example for hypothetical real estate fund. The tables nga akong gibutang show full result of year 1 and year 2. We'll start by working through the year 1 result. Capital expenditure taking in aggregate amount to 1 million and the depreciation amount to 400,000, taking the difference of these two terms yield the net capital expenditure amount of 600,000. Additionally, at the end of year 2, we know that the net working capital is 600,000, which is defined as the current asset of 1.8 million plus the current liabilities of 1.2 million. The change in the net working capital compared to the year 2 is 100,000. So, equal na siya, minusan na siya sa working capital year 1 o year 2 mo ng 500,000 minus 600,000 mo na ng 100,000 ang nabilin. Earnings before interest and tax in year 2 is 12 million, which is the firm must pay as 20% tax. The NOPAT left after paying the 9.6 million tax. Now that we have the year 2 terms, we can calculate the reinvestment rate. So, to calculate reinvestment rate mo to gain na. Reinvestment rate equals net capital expenditures plus change in net working capital over net operating profit after tax. So, mo ni siya. Ang 900,000 sa net capital expenditures plus 100,000 sa change in network capital na siya over sa net operating profit after tax mo ng 9.6 million. So, equals 10.4%. So, the reinvestment rate for the firm must is 10.4%, which means the firm reinvests just over 10% of the post-tax operating income to support capital expenditures or working capital.
So we are done with discounted cash flow. We already know what is yield rate, the uniqueness of the yield rate, and the reinvestment rate. So now let's proceed to interest measurement of fund. But before I start, let me introduce myself. I am Manilina Buemi, and I'm going to explain to all of you what is interest measurement of fund and one of its method, which is the dollar weighted rate of return. So the interest measurement of a fund refers to the method used to calculate the return earned by a fund over time. So there are two common methods of interest measurement for funds, which is the time-weighted rate of return, which will be discussed by my co-reporter later on, and the dollar-weighted rate of return, which I will be discussed in seconds. So, the dollar-weighted rate of return is a measure of investment performance that takes into account the timing and the size of cash flow, such as contribution and withdrawal. So, here's the formula of the dollar-weighted return. So, let A be the amount of the fund at the beginning of the year, B, the amount of the fund at the end of the year, and CT be the deposit in positive value or the withdrawal from the fund at a time. For ang withdrawal is negative gid siya. Kay withdraw biya gikuha. So of course that's negative. Ang deposit is add because nagdungag man kaog fund. So we can now see the formula that we are going to use for later on problem solving. So if ang pangitaon nimo is ang ending balance, which is mao ni ang first nga formula imong gamiton. If ang dollar weighted return kay imong gamiton is ang kaning ikaduha nga formula. If withdrawal or deposit gani mo follow ra ka ani nga formula kaning na arrow, which is kaning first pangitaon nimo ang interest, dayon next is kani dayong pinaka side nga gitudlo sa arrow. So para masabtan pa nato jud og maayo, ato ni siyang i-apply sa problem solving. So here's the problem solving. So a fund earning 4% annual interest has a balance of $1,000 at the beginning of the year. If $200 is added to a fund at the end of 3 months and $300 is withdrawn from the fund at the end of 9 months, find the ending balance using the simple interest approximation. So, atong pagitaon is ang ending balance. So, ako na ito giingon kinina kung unsa dapat nga formula ang gabiton if ending balance ang gamiton. So, I will give you a minute to solve. So, here's the solution for the example problem solving now 1. So, given is A, which is the beginning of the year is $1,000. Ang C is $200, which is deposit ni siya. Ang W is withdrawn, $300. And ang I na to is 4% or in decimal 0.04 4. So, naratong formula nga gigamit is, which is ang katong first. Then, mao ni atong solution, which is ang B. So, ang A di ba kay 1,000? Dayon ang 1 is given nga gikan sa formula. Then, atong I is 0.04. Dayon, atong close parenthesis plus 200 is atong 200 is ang deposit. Then, distribute 1, dayon 1 minus, ang time na to is 3 months man. So, in a year man ni dapat. So, 12. 3 over 12. Dayon, ang atong I, which is ang 0.04. Dayon, ang atong gi-withdraw, which is $300. So, negative ni siya, ha? Dayon, mo to, same process sa katong deposit, which is a 200. Distribute lang. Dayon, next is ang $1,000. So, give i-plus ni, di ba? Kung 1 plus 0.04 is equals to 1.04 plus $200. Then, dire, sa kanay ikaduha kay kanang 1 minus 3 over 12 is equals 3/4. Dayon, gikapira na ko ang 0.04 nga interest. Then, same process here sa ato ang 300 nga withdraw. So, mao na siya. So, atong ikadiri nga step is ato nang times, which is klaro naman, di ba? So, 1,000 times 1.04 is 1,040 plus $200. Then, times 1.03 minus $300. Kani kay ako rin i-calculate. If i-calculate ninyo siya, or basig inyo mano-manohon, makuha na Japon ang $943 nga ending balance. So, therefore, the ending balance is $943. So, that's for the problem solving no one. So, let's proceed to another example para mas masabtan kung unsa gini si dollar weighted rate of return. So, here's the example problem solving note 2. So, at the beginning of the year, an investment fund was established with an initial deposit of 1,000. 3 months later, a deposit of 1,200 was made. Withdrawals of 300 and 600 were made at the end of 6 months and 8 months, respectively. The balance in the fund at the end of the year was 1,400. So calculate the dollar weighted yield rate earned by the fund during the year. So I will give you a minute to solve. So here's the solution. So given is B is 1,400. A is, which is ang A is the base beginning. So what 1,000. Dayon ang C is 1,200. Dayon ang withdrawn is 300 and 600. So time, money being deposited and withdrawn, which is 6 months, natay 3 months, natay 6 months, ug nasa tay 8 months nga mga time nga gi-withdraw, gi-deposit ang money. So, here's the solution. So, akong gigamit nga formula is katong ikaduha, which is ang katong formula for dollar weighted rate of return. So, as you can see, nanay ako lang gi-distribute ang mga given, which is ang B is 1,400 minus A, which is 1,000 minus 1,200 which is 1,200 ang deposit. Then, ang summation of, mo siyang summation ha. So, as you can see, di ba, kaingon to ganina nga kung withdrawn dapat negative. Yeah, if mangutana mo nga nung positive ni siya, it's because di ba kakita yun sa formula is negative before sa summation. So, negative plus negative is positive. Yeah, same sa 600. Kuan Japan siya sa withdraw. So, withdrawn. Negative Japan siya. So, negative ni siya. Negative plus negative Japan is positive. So, mo na nga plus ni siya diri nga side. Which is, ang kuan niya tanan is 1,400 minus 1,000 minus 1,200. Which is ang deposit plus 300 plus 600. So, over 1,000 which is ang A plus summation of CT which is kato. Which is katong 1,200. Dayon, 1 minus T. Same process ganun na kaya ako running gilargo. Which is 3/4 ang answer kong 1 minus 3 over 12. Ang answer is 3/4. Dayon, sa 300 is negative naman siya. So, mga negative na sad ni siya diri. So, sa 300 is ang 300 kay 6 months. So, 1 minus 6 over 12. Ang answer is 1/2. Dayon, same sa 600. Ang 600 is 8 months. So, 1 minus 8 over 12 is 1/3. Dayon, calcu. So, sa babaw, ang kaning diri sa babaw, which is ang kaning A is kaning sa babaw nga formula is kaning 1,400 minus 1,000 minus 1,200 plus 300 plus 600 is ang answer ana diha is 100. And diri sa ubos sad kay kaning 1,000 plus 1,200 times 3/4 minus 300 times 1/2 minus 600 times 1/3 is ang answer ana niya is 1,550, which is kung i-divide nimo siya, ang makuha nimo is 0.0645 or in percentage is 6.45%. So therefore, the dollar weighted yield rate earned by the fund during the year is 6.45%. That's all for dollar weighted rate of return.
I am Nina Marie Dinoya from Group 5. I'm gonna discuss about the proper way to calculate the portfolio rate of return, which is the time-weighted rate of return. Let's define first what is time-weighted rate of return, or TWR. The time-weighted rate of return is a measure of the compound rate of growth in a portfolio. It is often used to compare the returns of investment managers because it eliminates the distorting effects on growth rates created by inflows and outflows of the money. It breaks up the return on an investment portfolio into a separate intervals based whether your money was added or withdrawn from the fund. The time-weighted return measure is also called geometric mean return, which is a complicated way of stating that the returns of each sub-period are multiplied by each other. When it comes to calculating the rate of return, the weighted rate of return is your holy grail of portfolio benchmarking because it completely eliminates the effect of cash flowing in and out of the portfolio. It is the rate of return that mutual funds and ETFs use when preparing their published performance report. Shown in the screen is the formula of TWR. It is TWR is equals to the quantity of 1 plus H P sub 1 multiplied by 1 plus H P sub 2 and so on, multiplied by 1 plus H P sub n minus 1, where TWR is the time-weighted rate of return, N is the number of sub-periods, H and P is equals to N value minus the initial value plus cash flow all over the initial value and plus the cash flow. And the H P sub N is a return for sub-period N. So how to calculate the TWR, or time-weighted rate of return? calculate the rate of return for each sub-period by subtracting the beginning balance of the period from the ending balance of the period, and then divide the result by the beginning balance of the period. Next is to create a sub-period for each period that there is a change in cash flow, whether it's a withdrawal or a deposit. We'll be left with multiple periods, each with a rate of return. Add 1 to each of rate of return, which simply makes negative returns easier to calculate. Last is to multiply the rate of return for each sub-period by each other and subtract 1 from the result to achieve the TWR. Now, let us see how the time-weighted rate of return works. Here is example 1. Investor 1 invests $1 million in a mutual fund A on December 31. On August 15 of the following year, their portfolio is valued at $1,162,484. At that point, on August 15, they add additional $100,000 to a mutual fund, bringing the total value of $1,262,484. By the end of the year, their portfolio has decreased in a value of $1,192,328. So the first period here is from the December 31 to August 15, from $1 million to $1,162,484. So to calculate this, subtract the end value from the initial value and divide all by its initial value. So the total return from the first period is $1,162,484 subtracted by $1 million, all divided by $1 million, which is 16.25%. So from the next period is from August 15 to the end of the year, which is from $1,192,328 minus $162,484 plus $100,000 divided by $162,484 plus $100,000. It is equals to negative 5.55%. So the second sub-period is creating the following $100,000 deposit so that the rate of return is calculating the reflecting the deposit with its new starting balance of $1,126,484. Again, Investor 1 invests $1 million in a mutual fund A on December 31. On August 15 of the following year, their portfolio is valued at $1,162,484. At that point, August 15, they add $100,000, bringing the total of $1,262,484. $1,262,484. By the end of the year, the portfolio has decreased to $1,192,328. So, the initial value is $1 million. From August 31 to August 15, his account increased into $1,162,484. This is the first period. So in August 15, the investor add $100,000, a total of $1,262,484. So by the end of the year, his account decreased into $1,122,328. Now this is the second period. So the formula for the sub-period is here. The period 1 and the period 2. The formula is the end value minus the initial value plus the cash flow divided by the initial value plus the cash flow. So here the end value is the end value of the period 1 is 162,484, this one. Subtracted by his initial amount, which is the 1 million, and since he has no cash flow, or we should say additional or withdrawal, so we should put 0 here, divided by $1 million plus the cash flow is 0. So his return for the first period is 16.25%. So in the next period, which is from August 15 to the end of the year. So same with the formula, the end value minus the initial value plus the cash flow divided by initial value plus the cash flow. So here, his initial value, his end value is 1,192,328 minus the initial value, which is from the August 15, which is the 1,162,484, this one. So, and the cash flow, which is the 100,000. Cash flow is his additional, this one. So he make additional 100,000 to his investment. If withdrawal, we can put negative here if it is said withdrawal, but it is a additional. Next is it is divided by the initial value and the cash flow. So the initial value is $1,162,484, this one again. And his cash flow is, which is his additional, is 100,000. So this one, 1,262,484. So the total return for the period 2 is negative 5.56%. So for the calculation for the total time-weighted period, so here is the formula. 1 plus first period, 1 multiplied by 1 plus the second period, multiplied by 1 plus the additional period, which is the n number of periods, all then divide and then subtract by 1. So here 1 plus 6.25%, which is the first period. Here the first period of return. 1 plus 16.25% multiplied by 1 plus negative 5.56%, which is the second period. And the result will be subtracted by 1. The total result subtracted by 1, so the total time weighted rate of return of the investment of investor 1 is 9.78. That's all.
Hi, this is Charlo D. Aying, and I'll be reporting about portfolio and investment year method. So let's define first what is portfolio method and investment year method. Portfolio method is all investors in the fund earn the same interest rates. So meaning wala siya special interest na ihatag bisan og new investors ka or even you are old investors. So it means you are with the same fund and you will be earning the same interest rates. while the investment year method is the investors in the fund earn interest that reflects when they invested their money. So, dire, in every new investors, na siya special interest when na siya special interest moto ang ginatawag og starting rates or the new money rates, and there is a segregation period, and during that period wala pay labot ang mga new investors sa main fund, and usually mas dagko siya interest rate during this period. So we have this example table. As you can see, you are given the following table of interest rates. So look at the first column, the Y, the Y meaning the calendar year of investment. And when we say calendar year, it is from January 1 to December 31. Mo ni siya ang calendar year, ang kaning mga 1992, 1993, 1994, and so on. And the next one is kana siyang I1Y, I2Y, I3Y until I5Y. Mo ni siya ang investment year rates. And then we have the values and they are in percentage. So wala siya nakabutan diri nga percentage, pero ang kana siya 8.25%, 8.50%, 9%, and so on. Ang kanay siyang I1Y there, guys, is mo siya ang notation. And then the last one is the IY plus 5, and we call these rates as portfolio rates. Mo siyang 8.35, 8.60, 8.85, and so on. Now, as you can see, na siya highlights nga kaning color red, and initawag nato ni siya o new money rates or starting rates. Mo ni siya ang ipanghatag sa mga new investors, and they are usually competitive rates kay ngano to attract or to gain more investors. So in this example, we have a 5-year segregation, pero which means 5 years naka-segregate siya from the main fund, and then after 5 years anha na nimo ibutang or i-appeal sa main fund. Unsay meaning ana? Kung nasulod na nimo sa main fund, you can now apply the portfolio rates sa imong investment. Like for example, you are in new investors from year 1997. But before that, ang kaniyang ato ni siyang i-explain ang I1Y, I2Y, I3Y, and so on until I5Y. Ang kaniyang Y, ang meaning ana is kanus aka nagsugod sa imong investment year, which is ang kaniyang 1992. Ang 1 represent na siya sa first year of your investment. So meaning 1992 of your first investment, 1992 second year of your investment, 1992 third year of your investment, and so on. So ang kaniyang 8.25 mahimo na siyang 1992, ang kaniyang ikaduha nga 8.25 mahimo na siya 1993, 1994 ang kaning 8.40, 1995 ang kaning 8.50, 1986 ang 8.50, and then ang kaniyang IY plus 5, Y is the 1992, right? Plus 5 is 1997. So ang imong portfolio rates is 8.35. So mo ni siya ang year 1997. So you are a new investor from year 1997. So meaning dili jud siya 8.35 ang ihatag sa imo ha kung ang i-apply ka invest year rates. So pangitaon nimo ang year 1997. So mangiari ka sa calendar year, pangitaon nimo 1997. So ang first year niya is 9.50. right? So if you are a new investor from year 1997, sa first year nimo atagan ka na nila og 9.5%. So you see, imagine you compared sa portfolio rate nga 8.35. Now, nga nang mas gamay ang portfolio rates compared sa new money rates? It's because the rates are being affected by the low performing investment in the past. Kay usually jud mas low ang portfolio rates. And now, pangitawan pa nimo ang year 1997, which is ang kaning 9.35. So, ari ka sa 1996, ang kaning 9.25 is money siya 1996, money siya 1997, kaning 9.35. And then next, ang ngita na po ka sa year 1995, magitaw na mo asang 1997, money siya 9.20. So, you can see a pattern nga maghimo ka og hagdan. So, from this 9.50 to 9.35 to 9.20, 9.10, 9 to 8.35. So as you can see, makahimo ka og hagdan. So let's move on to the example 1. So suppose that an investment account credits investor using the portfolio method with the annual rates in the following table. Now, suppose that 1,000 was invested on January 1st, 1999. So the question is, find the balance on January 1, 2000, find the balance on January 1, 2001, and the balance on July 1, 2001. So look at the table, year 1999, 2000, 2001, 2002. And then the portfolio rates is 4.5%, 5.50%, 4%, and 6.50%. Now the solution is 1,000 times the year you've started, right? So 0.045 is equivalent to 1,045. So mo na siya ang balance sa January 1, 2000. Number 2, 1,000 times 1.045 times 1.055 is equivalent to 1,102.48. So, muna siya ang balance sa January 1, 2001. Ang ikatulo, 1,000 times 1.045, 1.055 times 1.04, ano na siya 1/2. It's because from January, February, March, April, May, June, muna siya ang katunga, and then kaning July, another half na po siya. So that is why na siya nakabutang 1/2 or 0.5. So equivalent to 1,124.31, and this is the balance on July 1st, 2001. And by the way guys, muna siya ang example sa portfolio method. And let's move on to example 2, which is the investment year method. An investment fund applies the investment year method for the first 2 years, after which a portfolio rate is used. The following table of interest rates is used. Now the question is, Ashley invests 2,000 pesos into the fund on January 1st, 2000. The investment year method is applicable for the first 2 years. Na siya clue guys, first 2 years, after which a portfolio rate is used. Calculate Ashley's account accumulation on January 1st, 2006. So si Ashley ga-invest ng 2,000. So ang iyang solution na niya is 2,000. And then, nag-invest siya, first is it 2,000. At tuwan mo ang 2,000, then pinitaon mo, first, January 1st, 5.25%. So, may mo siyang 1.0525. Ang year 2001, mauni siya ang 5.25% gapon. 1.0525. 2002, mo na siyang 5.40% na siya sa portfolio rates. Kay why? Ang giingon man is the investment year method is applicable for the first 2 years. So, ari ra siya sa investment year rates. Aring kaning duha ka 5.25%. So, nana ka sa portfolio rates. So, 1.0540 and then the 2001, 2, 3, 2004 nimo is 5.65%. Mo na siya ang mahimo siyang 1.0565. Then, ang 2005 nimo is ang kaning mo na siya ang 5.10%, ang 1.0510, and the next is 1.534. So, equivalent to 2,731.37, mo na siya ang accumulation on January 1st, 2006 ni Ashley. Now, it's your turn for the problem set. Manilyn invests 1,000 at the beginning of 1989, 1990, and 1991 in the Confidential Experience Fund, which credits money according to the investment year method using the following chart. Remember that there are no withdrawals or further deposits. What would her balance have been on January 1st, 1994?
And to end our discussion, we would like to provide a conclusion. So in conclusion, discounted cash flow analysis is essential for assessing the present value of future cash flows in investment decisions. Yield rate provide insights into returns, each with unique characteristics, and reinvestment rates and interest measurement guide effective fund management, while dollar-weighted and time-weighted rates offer nuanced performance evaluation. Portfolio methods and investment year techniques contribute to constructing balanced, risk-managed portfolios. Together, these financial tools find practical application in real-life scenarios, shaping informed investment strategies and decisions across diverse industries.